Hey everybody, and welcome back to Watch Trading Academy for 2023. An exciting year ahead. Hopefully you've had a killer 22 and you're ready to kick off 23. So we're going to start the year kicking off 5 powerful predictions for what will happen in the watch markets in 2023. Now, you may have noticed pricing has been going down, and many people have called it the end of the watch market. Other people have called doomsday, like people are going to lose a ton of money. And contrary to what most people believe, the watch market may be down, but it isn't as down as much as people think it is. Partially because there is a very wide net or difference between the retail pricing, what is actually being sold for, and more importantly, what people are buying it for and paying on the wholesale market. So we've seen a major shift in 22 with watches having gone mainstream. And this is a big deal because when things go mainstream, that means the liquidity almost is continuous into the markets. Previously, liquidity may go up and down, and so liquidity had entered the markets on a very, very large scale in 22, actually in 2020, 21, and 22, and then putting us in 23. Now, what can we expect? So the first prediction we're going to make is around liquidity, and we're going to talk about the first 6 months. So we're going to talk about liquidity basically going away for 6 months and coming back 6 months later. So a lot of people are calling recession, long recessions, etc. I'm going to call something very, very different here. I'm going to say that over the next 6 months, somewhere between the now and this summer, we're going to see even less liquidity in the watch markets, and we're going to start seeing a significant rise in that 6 months later. So let's talk about this very briefly as to what does this all mean. Simply put, when we see watch pricing go down, watch pricing is heavily dictated on supply and demand, and even watches with very low supply and high demand are still being sold once in a while at a very cheap price, basically having what we consider a pocket deal. As long as these pocket deals occur, then ultimately it means the liquidity has left the market, meaning it has pulled back significantly. So you got to think about it this way. You could have a watch that is worth 100K and that is brand new would be worth 80K, but now used is worth 120K, and you might be excited about it. However, since there aren't a ton of buyers willing to shell out 120K, even though it could be worth 150 or 130, you are going to have what you consider a lack of liquidity push the price down enough until someone with liquidity says, hey, this is worth it for me to take a shot. This is one of the ways a lot of watch dealers have been pushing prices down and manipulating prices since the collapse. So this has been a big reason why pricing in so many watches has dropped, because dealers have taken a very different position, especially when the surplus of units started coming back in the market. So that is something that I think we're going to see in 2023. We're going to see a very split year. First 6 months low and second 6 months medium starting to trend back. So will we ever see pricing like we did before? I don't think to that level yet, but I definitely think there's some opportunity for recovery on many models that are currently significantly underpriced. Now, how do we know that? Well, we know that for one simple reason, which leads us to our second one, and this is supply at ADs. So the supply at ADs is going to go even more. I know people are saying, well, they're producing 10% more watches this year. Why would it go less? I am actually predicting a supply at AD is going to disappear even faster than previously, meaning there's going to be even less units available at the AD than there has ever been on most wanted watches. So this is my second prediction, and here's why. So there's 2 reasons why specifically the AD has played a role in this whole up and down. It's the fact that there are no watches for sale. So if you walk into a Patek 80 and want a 5991R, one is not available. It is very unlikely that it is going to be available into the next like 12, 14, 25 months. So at some point you say, hey, what is it worth for me to buy this? What should I pay for it used, since I want this and it's very unlikely I get it? Now, people believe that this has been the byproduct of COVID and a lot of money entering the market. This has always been the case with rare watches, even past 2017. So 2017, 2020, we were still dealing with a very similar issue. I remember in 2019 or so, I walked in an AD with an open work 41, and they looked at me and they were like, where'd you get that? Which AD gave you this? That's crazy. Like, I want that watch. So even the AD being impressed about something you're wearing at the time, where because again, supply was so short, and it was a very new watch. So this ideology that ADs are, again, getting stocked up and we're going to see a huge drop, in my opinion, is contrary to what's going to happen. As a matter of fact, which is basically part of my third prediction, I think that ADs are going to be significantly underpowered in supply on the right watches. Now, part of why is my third prediction is that China will help the market. And we're about to talk about that in a second after I go here. So once the Chinese market, which has just reopened about a week or so ago, with travel in and out of the country, units flowing back, deliveries flowing back, and more importantly, those tourists being allowed to enter foreign countries. Remember that China plays about 30-40% of the entire world stake when it comes to luxury items like watches, bags, and everything else. So a big portion of the supply that has been coming into the US has been the fact that China has been closed, and it has been very difficult for people in China to do business, regardless that they were going looking for a place like to buy things directly or that they were doing so online. So that entire economy had literally slowed the entire world economy for quite a bit, especially on the luxury side. So the China side is one of the biggest reason why the supply chain, I think, is going to be impacted very differently, and it takes us back to this liquidity. It's all interconnected. So when we look at that, I think China will play a significant role, but it's going to take a little bit of time, which is why I give it 6 months to, again, start to trickle into the supply, increase liquidity, and then eventually start getting more liquidity, and so on and so forth. So I think that that will significantly help everything. And we're about to kind of play out how this plays out in the next 6 months. But I think that this is a big piece of it and something that we need to keep our eyes on. Now, the other piece that I think is a very important prediction for 2023 is a lot of gray market dealers are going to be out of business. This is a reality that we've seen. Remember that I want to just bring this up. Like maybe the big ones, I don't think they're going anywhere because they've historically learned how to navigate good and bad times. But I think the newer ones that are coming to market. So let's kind of think about what happened in 2008. This is a good parallel to kind of compare. In 2008, the mortgage industry boomed. So did real estate, right? Like previous to 2008, all the way to 2008 before the crash. So during that time, you even had strippers that were basically loan officers and mortgage lenders because everyone was making so much money and the business wasn't so much about being good at it. It was just about servicing. So you didn't need someone to be a good loan officer. You just needed them to take the paperwork, take the applications, and make their money. That's how everyone and anyone was playing in the markets. That's kind of what we saw in the luxury segments because of the liquidity increase in the last 2 years. Like you saw a ton of people buying Lamborghinis and you saw a ton of people buying watches. Now, what happens after that is that there was a significant need for more businesses coming in to service that. Used exotic car dealers and of course, used watch brokers. Like regardless that they were watch brokers or watch wannabe dealers, gray market resellers, or just individuals who are just flipping watches in between, the volume of that increased significantly over 2 years. So we're going to see that flipping kind of concept start to hold back a little bit. Now, this is very important to understand because remember, these guys came into the market during these 2 years as opportunists, not because they're good at it, but just because they were out there making easy money. Now, as the money leaves and relationships take a bigger toll in the next 12 months, meaning people buying from repeat sellers and buying from people they trust, especially with all scams and things out there, being afraid to lose some money and so on and so forth. This is a very big concept that I think you're going to start seeing a lot of these guys disappear. Now, this is important to realize again because by them disappearing, what does it mean? Well, it means much more transparent pricing because right now what you have is when a watch enters the market, if it's priced well, you have someone that can snatch that watch and then resell it up. So it pushes the price up. It creates less price stability. As you get the market back in the hands of those that are doing normal, real long-term business, you're going to have better margins come back. So this is why it's such a good time to get into actually watch trading and not so much just flipping and brokering. So there's a big difference between the two. And I think you're going to start seeing that play out. If you've been just hawking stuff because you had a friend that gave you something or you were able to get a watch, well, that stuff's going to stop. But if you've been building a business around this, or you've taken the training that I teach right in the description and you understand how to do this, or you've even joined Watch Training Academy, this is going to help you quite a bit now, because these cartoons that basically destroy and manipulate markets are going to slowly disappear. And this is very important. Now, what does this tell us? Well, simply put, it brings us back to price, which is something that everyone's been asking about. When will we see prices go up? Will we see further prices come down? Which is my final prediction for 2023. Simply put, let's think about price in a very simple way. I've always said in luxury assets, in cars, watches, art, or even looking at specifically handbags or anything else, price is a byproduct of supply and demand. But supply and demand is not just how many units are on the market on the use side, it's also specifically playing out here at the AD. If someone is in a capacity to walk in a Hublot boutique and buy a Hublot at MSRP just by walking in and saying, oh, you have a blue Hublot, I'd like to buy that, that's great, I'll put it on my wrist, what's the MSRP? It's $29,000, cool, I'll just send you money or I'll pay with my credit card. The price of that unit is going to be significantly discounted when used, because the new unit is widely available at its cost. There would be no reason for someone to take that same blue watch, put it on the market used for $35,000 when anyone can walk into a boutique and buy it for $29,000. Therefore, the price has to go down when the supply is readily available. Now, it has been probably 6 to 7 years since you've been able to walk into an AD and literally have the watch you want on demand available today. And that industry isn't poised to slow down no time between now and 2025. As a matter of fact, this industry is supposed to turn into a $30 billion industry by 2025. So what is it here specifically that pushes prices up? Well, simply put, as long as you can't walk in to an AD and get a Rolex Daytona Platinum with baguette dial at MSRP just by asking for it, then there will always be a second run or need in the secondary markets. This is no different than Birkin bags or anything else that is highly sought after. If you want a car and the production is 100 units and these 100 units are sold, you are forced to go into the used market and basically, based on what's available there, make a choice on what you can or cannot buy. And the price then is dictated heavily by liquidity. Because how much liquidity? I mean, like in a recession, for example, I got a great deal on a Bugatti because no one else was out there writing $3 million checks. So I was able to get a fantastic deal on a car. While people are paying way over MSRP, I was able to leverage liquidity to help myself. On the other hand, let's say that wasn't the case, right, and liquidity was not really an issue, there would be no reason when a car is sold out for it to sell at MSRP if you still can't walk in and buy one, especially when it isn't in used shape, meaning it hasn't been damaged, driven, or anything else, but it is now available to be bought. And so that is something very important to understand. So price is directly correlated to that. And if we're talking about liquidity increasing in the market in existing spots, we're talking about China coming back as users, we're talking about the guys manipulating the market going away a little bit, then we have a really good recipe for a price up during the third and fourth quarter of the year. Now, so this is the recipe. This is where the data points to. Is it possible that I'm wrong? Absolutely. There could be some last minute, thing with the war in Ukraine and Russia getting even worse and causing significant supply issues. These could even cause a dramatic recession to be enhanced and go on even longer, or create significant turmoil in Europe that could now impact the fact that the Chinese market is back but the European market is out. So we've talked about recessions in the UK causing issues here. So there's a lot that can play in this, but right now everything that is here, assuming none of the other things change, is pointing to prices going back up. And partially because a lot of the prices, not on all units, are simply being down based on liquidity. Now, if you watch the stock market, there's something really interesting. If you watch really good analysts in the stock market, not the Kramers of the world, the guys that are always wrong, but the guys that actually look at real data, they'll tell you something. They're like, why aren't you concerned that the stock market will collapse even further like every single day this year? And the answer is usually that if you take in the economic factors that are in play, the pricing of many of the stocks are already undervalued and overreacted to the situation. And I think that is exactly what is happening here in a lot of different watch models. Yes, there are some that are probably never coming back. Day dates historically were never over MSRP except for the last 2 years. But the majority of Daytonas have always been. Now, in addition to that, I mean, I remember back in 1998 or 1999 and 2000, we had Daytonas that were going over sticker. This has kind of been the fold forever. Birkenbacks have been the same thing. Even in the best cases, they've always gone something over sticker. And is it possible that they're going for significantly more? Yes. But if we compare the same parallels with bags, the same thing happens. That, like, if we think about Birkenbacks, they've gone up, but Chanel came up recently and then ended up going back below MSRP. And this is a good example of the fact that what once was in the behavior of how people bought is now restored, meaning nobody walked in and bought Hublots or GP watches at over MSRP. This did not happen except for the last 2 years. And now that this is done, the expectation should not be for that to come back because it was never the case. And so the argument here is that watches currently on certain lines are below where they would be. And so there's a significant opportunity here to basically understand that there are certain watches that are going to do significantly better over the next 6 months and be positioned for a good rise. So in a future video, we'll identify specifically which watches these are and what you need to be considering. Well, that list is already here at Watch Trading Academy for our members, but for you guys, we'll give those guys a couple of months heads up so they can get there, but we'll let you get a peek of that as well in 2023. So make sure you click the link right now. Take the training if you haven't. Make sure you take the join the course and join our community of incredible watch traders. And together, let's make 2023 count. So click like, subscribe, turn on notifications, and I'll catch you next time.